Welcome to the December and January market diary. Now, I know what you guys are all thinking. Oberst, why can't you seem to get a video out a month? Well, I've been very busy at the end of the year, beginning of this year, and for most of quarter four, I was incredibly busy. And just because I'm not putting out a video doesn't mean I'm not actively thinking about this stuff, so it's going to get combined because this is the first chance I've gotten to actually put one of these together. So, in effort to be able to give you some actual decent insights this time, this is probably going to be a bit of a longer video because I do actually want to say some things other than look at this chart and see number go up. So without further ado, let's start off with the first set, which is the FOMO regret is real. So as you guys know, I am in Microsoft and Amazon. Microsoft, I happen to have gotten in a second time at $317.96, and I only rebought 5 shares. Now, that's after selling 20 shares back at $248. Now, the price between $248 and what it's selling at today is almost double. And I don't see it quite hitting 500, but Microsoft went from making no revenues from AI to making revenues from AI, which was the first major hurdle. And then also it's increased its cloud computing revenues as well. And that wasn't something we were seeing back in July when I sold. Its fundamentals were not matching up with so every single stock price has price, and it has something called a market multiplier. So that multiple that you see can sometimes go up like 20, 30. Like it on the big techs, the earnings number that you're looking at versus the multiple number you're looking at, it doesn't always line up. And for Microsoft, and for a little bit more Amazon, back in July, those numbers were very out of proportion, and one of the things that can cause a stock to drop is the multiple to drop. If people don't think that those revenues are going to go out into the future as far as people are saying they're going to go out, then you can see a stock decline. And one of the things I was worried about, and to a minor extent we saw in the first half of half one of 23, you saw Microsoft and Amazon retract a little bit. Now, I thought that retraction was going to be a lot more aggressive than it was, and I thought it was going to continue. And then they put forward several quarters of very, very good earnings. Amazon in particular had very good on AWS, and their losses on their retail side were not as bad. And as such, their overall earnings and their bottom line cash flow looked very, very, very good and healthy. And it's caused both of these stocks to jump. And these two charts I cut off at the end of January because this is a January market diary. But their last quarters caused some insane upside. That isn't seen here. And I really did miss the mark where I bought, I only managed to buy a couple of shares in Amazon, and it wasn't even that many. It was just because I had dividends come in, and I noticed I could buy 3 with the dividends that came in. So I put it in Amazon. So I am now looking at Microsoft and Amazon going, I think there is multiple expansion possible. I also think there's revenue expansion possible, which means I think there's going to be a continued run-up in their stock prices. Now, do I think that it's going to be another 100 points? No. Back in March of last year, when I first opened up my Amazon position when it was at $98, I actually thought that Amazon would take 3 years to get to 171. It took less than a year. Microsoft, same deal. I thought that 250 would eventually become 350. It took 6 months. And 350 was my exit point originally for Microsoft, and 171 was my exit point for Amazon. The only problem is because of the string of bad quarters, I got nervous and I sold. Now I'm trying to buy back a position where I don't think there's as much upside, and I don't know if it's it's a good time to invest because it's already run its course and now I'm FOMO investing, or if they have more room to grow and they actually have the ability to expand their businesses. And I'm leaning more towards that they have the ability to expand their business. So with that, you can see that my average purchase price for Amazon has really gone up from where my average purchase price is. Now, you can look at that historical shame of one of two ways. Either I got out way too early, but clearly there was a dip because I bought it 40 points back. I didn't have the money to buy all of them back to get that dip buying. And same here. I sold here and I bought back here. What this doesn't show you, and if you didn't watch it, was the stock price made a U-shape where it went up to 150 and then right back down to 129, which is very similar to what this quarter is looking like, which is why I'm worried to put money in because we're at an all-time high. Now, I did buy more at 152, which brings my average purchase price up to this 137. Now, if I'm going to buy even more, this is going to get pushed up to about 150. And same here, that average purchase price is going to go up. Now, if I think there's a lot more run room, then maybe it's worth putting more money in, but I don't know what that entry point looks like. I do eventually want to put about 10 grand into the total purchase price for each of these. I just need to make sure that the price is right. Now, something that I did buy the dip on and something that I've been telling myself since June, July. Again, a lot in half one is where a lot of these short-term strategies started to come into play. And if you do watch this whole playlist, which I do recommend you doing because it's very interesting to watch how my mind has evolved over the year. One of the things I kept saying was, if Exxon got below 100, I would buy, and I would buy a significant amount because it bounded between 100 and 120, depending on what was going on in the world. So I did end up buying 30 shares at just under $100. Now, I did this in the middle of January, but I had the option of either doing about 25 shares of Amazon or 30 shares of Exxon. Now, I was only looking for a $20 jump, and I thought that gas prices, now that winter is ending, the more expensive gases are going away, the more cheaper gases are coming in. But there was also a lot more driving that was about to start happening. On top of all of the mergers and acquisitions and new revenue streams that Exxon was looking at, I thought, all right, maybe this quarter we'll start to see some of that get taken into account on the multiple side of things. Because I think the price for what their earnings is probably right around that 110 mark. I think that's probably the fair price at the current multiple level with what their earnings are. So I thought, maybe within a couple of months it would get up to 120. I could sell off the 30 shares and put them into big tech. That would be a decent gain for a couple of months, and I could put it into a bigger driver. Now, what I wasn't expecting was that Exxon would continue to kind of peter out around that 105 number and bounce between that 105 and 90 number, or 99 number. And it has continued to do that for a while. So if I'm just looking for that 20-point jump, then why am I not just putting that 20-point jump into Amazon, where it seems to be doing that every couple of months, and same for Microsoft. If I'm just looking for that gross jump and not that percentage gain, what's going on? Now, ENBRIDGE, I happen to have a couple of dollars left over, so I bought one share of ENBRIDGE near its peak. Now, I'm not thrilled with ENBRIDGE, but it is a decent dividend gainer, and what I've been doing is I've been trying to get my dividends up to a point where I can reinvest them into these different stocks where I might not have extra cash left over to just be putting into the stock market from my day job, essentially, because that's how I'm funding this account. Is whatever I'm not spending in a month, I'm putting into this account. So I'm trying to get it to the point where I can get a decent amount of dividends that I can put into other stocks that I wouldn't otherwise be able to fund, especially if I'm seeing a dip or whatever. Now, that gives me quarterly buying opportunities with a significant amount, but as these valuations get bigger and bigger, I won't necessarily be able to buy a decent amount of stocks because these prices are going insane right now. And that's one thing that I am actually worried about, is that the pricing level is not matching the overall economy and the overall. I think the market is in a frenzied area right now, and I'm worried about a decent sized retraction, and I'm not entirely sure when we'll get to a point where revenues match output. And I think we're right on the edge of it going one way or the other, and that's the risk right now. Is it's either going to start off another bull run, or we're just seeing what the Fed is doing. We're seeing what all these other macro environment things are doing, and we're saying we think the consumer is strong enough to keep going. And Exxon is heavily driven by the drive market, and also just I don't want to say it's driven by what the Middle East is doing with their price fixing, but it does heavily depend on how the Middle East is faring on whether or not Exxon is going to go up or not. And right now we're seeing lower gas prices than we would otherwise expect. And ENBRIDGE, the winter should be good for ENBRIDGE because they're the ones that carry natural gas. Natural gas in the winter should go up, especially because it's bought a lot of American pipelines, and it has to deal with Canadian gas as well. So I'm happy to see that they've come up from their lows, but I also understand that ENBRIDGE might not have a lot of room to run, and I should just be holding it strictly as my 8% is coming from their dividend, and almost strictly from their dividend. So, yes, I bought a lot more for both ENBRIDGE and Exxon. As you can see what the average purchase price is, I'm slightly down on ENBRIDGE, and I am, well, at the end of January 31st, I was down on Exxon, but I was above that average purchase price for a large part of these 2 months. So I'm not unhappy with where we are. We're bounding around the average, and I don't think that I'm at risk of losing anything that I put in. Now, we can see my history with both Exxon and ENBRIDGE and where I tend to like to buy. And you can see that I'm always buying around that 105 to 99 price point. And I do that fairly consistently. So with Exxon, you can see where I think they are fairly valued. And cumulatively, including dividends, I am up $160. Now with ENBRIDGE, you can also see that, I'm making a decent return on ENBRIDGE, but I'm only looking at about $90 for the 7,000 I put in, which again, for the 13 I put in, I'm only looking at about 95 for Exxon. But after taxes for ENBRIDGE, I'm only looking at about $90. That $19, $20 that you see in red, or non-red, in parentheses, those are Canadian VAT taxes on dividends that we have to pay because ENBRIDGE is a Canadian company. Overall, I am down about $45, but I'm not unhappy with ENBRIDGE at the moment, even though I am net negative since I've opened this position. Now, one thing I did talk about in November was that I was unhappy with the small caps. So, as you can tell by the title, I did sell both VB and VBK. I exited my position entirely. So I closed 8 shares at 213. You can see the green line is the level I bought. The red line is the level I sold at. And as you can tell, and I dragged that line out further past where I sold it just to show that I bought it at a decent high for if I was planning on selling it in January. I sold it at probably one of the best points I could have sold it at, because there was very few times where it was above that red line. So I did make a good call as far as if I wanted to sell during the month of January, which I just wanted to be out of small caps, then I made the right call. And the same with small cap growth. I sold at pretty much the height of where I could. I sold it at the top of the last 2 months, and it was for a profit overall. I closed all 7 shares at 241. Now this is where I got a lot of the money to move around what I wanted. And one of the things was that I went into these because I was worried about Microsoft and Amazon, and when that thesis was proved wrong, I didn't go into these with the right mindset. This wasn't a long-term strategy to me. This was a buy and hold so that my money could at least make some money over a 6-month period where I tried to figure out where I wanted to put it. And that was my fault. I shouldn't have done that. I should have stuck with Amazon and Microsoft, and instead I went with something that I wasn't thrilled with, that I didn't fully agree with, and that I could have gotten exposure to in a different way if I had gone VTI instead of VU. Now, I'm not thrilled with small caps, even though small caps are where a lot of the returns for the market comes from. I just don't like these indexes. I'm sure they're great for some investor somewhere, but I am not thrilled by them, and they were not right for my particular situation. Would they be right for someone else? Absolutely. Were they correct for me? No. And that's why I got out. You can see that I was in them for just about 5-6 months. And I bought them on the same day. I sold them on the same day. We didn't make a ton on them. We made less than $100 on each of them. And it was an overall failed experiment. I didn't lose any money, which for the most time I was in this stock, they were losing money. So I did end up closing at least in the green, which is another thing. If you look back here, that 200, 195 wasn't the lowest it went. Like, these were significantly lower for most of the year. So I've been in the red since I bought them, and I just wanted to get out. I was tired of them. But one thing that you can't do is beat the S&P. And even though the S&P as a whole did very bad in H2, it is starting to get its feet back under it. And again, a large part of this is whatever we're calling Magnificent 7. Now it's Magnificent 5 because Tesla decided that it just was going to lose a quarter of its value in a single day. Yeah, that was a fun disaster to watch. But then you had things like Facebook, where because they announced a dividend, they went up 25%. So the market can remain irrational longer than you can remain solvent. It's something that I have taken to heart, especially when I used to be an options trader. Do not assume the market is rational. Assume that everyone is emotionally investing. The big institutionals aren't going to buy or sell. They're going to hold. And because of that, all of the volatility is coming from individual investors or AI traders. The AI traders are just looking for news in the market that they think that, different keywords will trigger different emotions from people so that they will do stuff in the short term, and AI traders try to make money off of that. And that's a lot of the volume. And then you have normal humans like us who see stocks doing one way or another. We can't stomach the risk, so we just sell. And on the converse side of that, because if you want to take the positive look of it, we can overhype something, and we do overhype things quite frequently, especially with all of the, and I'm adding to this by putting this on YouTube, but with all the YouTube influencers and Redditors and all these different message boards, we really can overhype the market. And we do that, and we can do that for a long time. So when I say you can't beat the S&P, I mean you literally cannot beat the S&P, because the S&P takes all of the stocks that we might want to hype up or not hype up, and then here's an index that tracks them. And I know I went through a rough patch in H2, but it has shown that this is actually a safer way to invest. And I did go back through and see if I just entered in at a bad time, and like a back test would actually show that no, are in a good spot. I backtested, I'm in a good spot, and I'm a lot happier with VU now. As you can see, I am up overall after being down a ton, but we are actually up. Average purchase price of $4.15 with 22 shares. I haven't added to it since July, but we have gotten dividends from it, and we are up overall, and it's not a bad spot, and I will add to it once I get to that 10,000 mark from Amazon and Microsoft. Once that happens, most of my money will be getting parked into VU. Now, reinvestment grade. So, Walmart. I bought 22 shares of Walmart from the proceeds of selling both of the small caps. Walmart had interesting news that Walmart decided it was going to do a 3-to-1 stock split. I don't think that's where a lot of this momentum came from. I actually think that they just had a bad quarter at the end of December. And because of that, the market overreacted. It presented a buying opportunity for a lot of us. And when that did happen, I bought because I saw that it dropped down to 156. I knew that it was about a 164, 170 stock and should be around there. So I said, yeah, sure, absolutely. I will take this dip and I will buy it. Walmart, I do actually like what they're doing. They are, in a time where food is going up, in a time where basic necessities are going up, Walmart is able to compete on price and compete on a way of getting middle-class people to actually spend money in their stores, that I am very, very happy with Walmart as a company. I think that they're going to have higher revenues as a result of a weaker economic environment, where they're getting not only low-income people, but also middle-income people, people who have white-collar jobs are still going to go to Walmart because they can save 50, 60% of their grocery bill or general needs by going there and buying food there. I know I'm in that camp where I could go to a Stop and Shop or a Publix or Kroger or whatever that is for your general area, or I could just go to Walmart, get the same food for half the price. I make enough money where I could buy brand names. I don't. I go to Walmart. And I know a lot of my colleagues and a lot of the people in my circles are starting to do the same because food prices are ridiculous. This is why I'm invested in Walmart, because if people in my circle are going to Walmart, then anyone below my means are probably doing Walmart or Dollar General, and we know they're not doing Dollar General right now because we saw Dollar General's earnings, so a lot of them are piling into Walmart. So I think Walmart has a decent revenue share for the foreseeable future while the economy is struggling. And just by credit reports that we've been seeing, we know the economy is struggling. Credit card debts and defaults are up, and it's going to be, the consumer spend is going to be an issue going forward through 2024. We just know we know that is happening by the Visa and MasterCard earnings reports that came out. Now, the other thing that happened was Aries. I bought 363 shares of Aries at $19.87 per. This brought my total amount with Aries up to over 600. Now, was this a good price to buy at? I didn't really care. I think that it's going to continue trading around this 1920 mark for a while. The bigger thing is Aries is continually growing its dividend, and at the moment it's at $51. If you can see where my average purchase price is, it's way down here. But one thing you didn't notice was I bought here. Earnings were my dividend payout was here. Like, they are very close together. I needed to buy here in order to qualify for this dividend. And if you look here, I did. $318 per quarter is what I'm now looking at from ARC. Now, you can see I'm now up to 663 shares of ARC. I'm only up to 54 shares of Walmart. And yeah, Walmart's putting out a fairly consistent dividend, and so is Ares. And you don't understand how happy I am. Both of them are boring companies, but they're consistent. They're both at $1,000 year to date from what I put into them. With Ares, that's a little bit less than, well, actually, no, that's exactly 10%. It's a 10% gain off of what's in there right now. And with Walmart, it's a little bit more than, it's 7-1. So I don't feel like doing napkin math here, but that's probably close to 15 to 20%, probably 13 to 15%. Yes, I'm trying to do that in my head. It's not going well. But they are boring but consistent. They are the ones that I'm seeing the most consistent returns from. So I'm happy with these two because they're not losing me money and they are making me money for my more riskier ventures. Now, if we look at the December 29th final numbers, you'll see that of the 50,000 I invested, I made just shy of 52. And my quarterly dividend amount was about $6.25. Now, that massive jump came largely from me buying ARC. And you can also see that everything except for Exxon and ENBRIDGE were in the green. So we weren't doing badly. Both Microsoft and Amazon, if you look there, you'll see a $300 gain off of 5 shares, which is insane to me. And you'll see a $100 gain off of 8 shares. Now, if you remember by the chart, the big blow up was in January. Now look at those numbers and you'll see that we went from 5,300 invested to 5,600 current value. Now, cost of trade includes dividends I've reinvested over time, but we also just in January gained another $25 in dividends per quarter. So you'll start seeing as the year goes on that we'll be at about a $2,600 dividend for the year if I don't sell anything. Because one of the things I was trying to do was to get to that 5% dividend yield to reinvest about 5% of what I got out without having to sell things. Because the whole thing was that, a lot of people will tell you that dividend investing is not worthwhile by the data and the statistics where you should just be selling and reinvesting into a different thing if you need cash flow. One of the things I like about dividends, even though it's a taxable event and that takes off from the overall dividend yield, one of the things I like is that I can keep my principal and put the dividends into the shares of a different company, and that's where my reinvestment goes. Yeah, it might knock down the total overall value of the trade, but if I could only sell 8 times in the case of Amazon, or I could only sell 22 times in the case of VU, I'd rather take that dividend and instead of having a higher number where I can only reallocate and move 22 times, I'd rather take the extra $30 and put it into whatever other stock I want. And I'm looking at VU in that case because it's about a $30 dividend right now. Or in the case of ARC, yeah, I have $1,200 in there and I could be putting them into Microsoft or Amazon and making significantly more money, but I'd rather have that consistency of an extra $400 so that I can buy an extra share of Microsoft or I can buy an extra share of Amazon. Like that kind of thinking is what I am using my dividends for. It's for reinvestment. It's so that even if I accidentally overspend in a month and I can't put any money into savings, I at least have the dividends to buy more shares and compound those gains in better performing stocks or stocks that I think are going to perform better, which should, in theory, help me to stop selling as much because that's the problem. I'm selling too often. Now, if you're looking here, I've said multiple times that I want to get every single stock I own up to a base of $10,000. And from there, I'll add or remove based on market conditions. But I want to get that $10,000 base just so that I have a snowball that can start to be made. Because if you ever look at those exponential charts of saying what happens when you invest, having a decently sized base will allow you to start growing that snowball faster and faster and faster. And one of the things I want to do is to be able to make that 1% feel like a lot more on a gross dollar value than 1%. 1% on 1,000 is $10. 1% on 10,000 is $100. Now, if you somehow manage to get a 8 to 10% stock, you're talking $800 to $1,000. I want to be able to get that $800 to $1,000 off of that 10,000 on gains and dividends. Because yeah, this dividend yield is low, but we're talking, we're still talking like $123 in a year off of this. So when I look at these dividends, I am thinking this is a reinvestment vehicle. And as I'm going through this year, I want to start thinking in a more long-term mindset, get out of the trading mindset, and just say, no, I'm going to add to these positions in a regular manner that will get us more money. I'm going to stop trying to time it, and I'm just going to go for it. And these are the stocks that I want to tie myself to for the foreseeable future. No more playing around with other kinds of ETFs. No more playing around with, I heard this is good, this is good. These are my 6 stocks and 1 ETF. The ETF gives me the diversity. The 6 stocks give me the possibility of gain with the additional risk. And that's how I want my market. That's how I want my portfolio to look. Now, if we look at the year-end checkup, you can see that at the beginning of December, I had about $48,000 in. 52 at the end of December, and 56 at the end of January. Now that would seem like I made almost $8,000 in this period of a month. But of course, we know that actually I funded the account $3,000 in the middle of January. So it's closer to $5,000. And you can see that, yes, I did have an 8% gain in those 2 months of just shy of $5,000. Remember when I went back to saying that the more money you have in your account, the more these smaller percentages seem to mean more? Well, I have almost $56,000 in this account. 8% is finally meaning something. So that's almost a full month's pay in 2 months on just gains versus just not investing my money or spending my money on frivolous things. And this is why I like investing, because it lets me show that not enjoying my life to the fullest right now is worth future gains in the case of right here, where every dollar invested could make me more money than going to McDonald's and buying a Big Mac or, really splurging out on those nice restaurants. Could I go out and buy a luxury watch right now? Absolutely. Am I going to? No, because that's going to cost me on my percentage. And that is what I'm looking at. Now, if you look at profit or loss since open, not including dividends that I've put into it, I've only made about $2,300. But we are also looking at one other thing. We're looking at dividends gained since open. I made almost $1,300 in dividends since March of last year. Unrealized gain since open. That $2,300 is just over what the principal I put in, and just over, and not including the dividends I put back in. So technically, if you want to include dividends, and if I sold everything right now, we're looking at $3,600, which is 6.6%, which is more than what I wanted when I originally went into the market investing. Now, sure, if you're pegging this to the S&P, I did awful in the last year, because the S&P did, I think it was like 18 or 20% last year, versus just investing in the S&P as a benchmark. I did absolutely atrocious. And a lot of that came down to me selling Microsoft and Amazon, because the S&P was overly influenced by the Magnificent Seven at the time. So yeah, could I have done better? Yeah, it would have involved me having to be heavier into the tech industry. And I didn't want that. I was looking for a safe way to grow my money in a consistent manner of around 8%. And that's what I did. I am just shy by 2% overall for the year, and that's with me just getting started. And for the account size I have, and for the learning hiccups that were along the way, I am very, very happy with this result over the last 11 months. Now, what are we going to do in February? Now, I know I'm putting this out halfway through February already. It's February 11th when I'm recording this. But one of the things I want to do in February is fund this account. So saving up from the last 3 months, I have a significant amount of savings I can put in February, and I just want to know, what I'm going to put it into. I am heavily leaning Amazon. I think I am going to try to buy into Amazon. Now, it's after one of a major jump because they had such a good earnings. So I need to figure out if me putting it in at the end of the month is better than just putting it in within the next week. So we'll find out what we're doing. But I'm definitely going to be adding a decent amount of money to this account. I am going to be, like I said, buying Amazon and Microsoft. I'm probably going to buy 9-to-1, which means if I put in $5,000, I'm probably going to buy one share of Microsoft and the rest is going to Amazon. That's what I mean when I say 9-to-1. I'm only going to add like 1 or 2 shares of Microsoft, and everything else is going to go Amazon. Just because Microsoft is so expensive right now. And also, Walmart did announce a 3-to-1 split. Now, splits don't mean anything for the stock, but what tends to happen during splits is people buy before and buy after, just simply because on the pre-side, people think that once the split happens, there's going to be an increase of activity because the stock is now cheaper, so people who are standing on the sidelines will now go in. Even though there's no fundamental financial reason for this happening, it's a psychological phenomenon that we have seen that split activity causes, on average, short-term rises in the stock price. So when Walmart goes down to $50, it will be very interesting to watch. So those 54 shares are going to turn into about 160 shares the next time we talk. I don't quite know when the 3-to-1 is happening, but it's happening soon. Anyways, that's my plan for February. Again, here's my rules of engagement. We will be editing this the next time that I see you, because my goals have changed, my rules have changed, my thesis has changed. But yeah, this is what I've been working on for the last month. And if you can see, I wanted to get to that 7 to 9%, and we got there. 6.6 is essentially 7 in my eyes. I'm rounding up there, and my overall goal was met for the year. It was on the low end. It was 7 instead of, the 8 that I wanted, but we still got there. So that goal was checked off. Anyways, so please do read my general disclaimer. As always, not investment advice. This is entirely on me. I am mostly talking to myself, for myself, so I can watch this back as the year goes on and see what my thought process was at every time throughout the year. And with that, I want to say thank you very much. I know this was a very long episode. It's nearing almost 40 minutes on my end, but I do appreciate you guys watching through to the end. And if this was something that you found interesting or usable, please comment, rate, and subscribe. That thumbs up helps. Tell me what you think. Tell me what you think I'm doing wrong. Tell me what you agree with. I do value input in this, and yeah. Thank you so much for watching. I will see you all in February. Bye.